Thanks for all 20 of you for joining me for this one. I actually want to take a step back. I know a lot of people here, we're here to talk about, or we're coming to this conference to really talk about digital money. But I think what we're seeing right now is a lot of the discussion on digital money is really about the currency itself, right? Whether it's the Bitcoin, Ethereum, whatever cryptocurrency, or things about how to distribute that piece of it. But I think when you take a really big step back and think about money and digital money itself, the piece that's missing is the way we're using money right now is barely even digital. So before we get to the point of talking about the digitization of money itself, I think the biggest opportunity when you think about financial services, fintech, consumers, is really about how do you actually make the use of money right now digital. So the analogy I was telling someone here earlier today was, if you think about digital money, I think right now what you're seeing is there's two things. There's a lot of people building beautiful, amazing new cars, right? But the problem is we don't have the roads for those cars yet, right? The way we use money currently is on crappy dirt roads, and we're trying to ride our bike on it. So it's this idea of, I think the first opportunity, the biggest one that's out there, is to actually digitalize that, to pave the way for distributing all the financial products we use right now. And then once that baseline is there, then how can we use these beautiful cars or destinations and kind of connect it all together? And so I'm just going to run through that quickly, hopefully leave a little bit of time for Q&A, and talk a little bit more about distribution. So going back to that idea, right, the biggest challenge I think financial services faces is really, one, this next generation, and two, how financial products are going to be distributed. And this can definitely include currency, or how we use currency, how we spend money. Awesome. And so one example is, let's look at insurance, right? Insurance is a multi-trillion-dollar industry. People like yourselves and myself put a lot of money into insurance. We use it. It's a big form of how we use money currently, but it's still often kind of stuck in this era. And if you look at the reasons why, it's really this idea of how it's distributed has always typically been driven by kind of like feet on the ground, right? In person, someone calling you, someone sitting down with you, someone at the bank trying to sell you insurance. What we're seeing is there's a shift right now happening from this idea of one, feet on the ground to digital, and two, the idea of selling these products or pushing these products to people, to this idea of people wanting these products themselves and getting it themselves. And so even when you look at these archaic industries and say, well, who cares, right? Insurance, there's insurtech, mortgages, there's mortgage tech. The problem is a lot of these tech verticals of these companies still don't solve the biggest problem, which is distribution, right? Insurtech really now innovates the customer experience that's needed, that's great, but when you think about distribution, Insurtech itself barely touches it. It used to be in person, and now they're doing digital ads, but that's almost circa 10 years ago. And when you think about money, it's not just insurance, it's all these verticals that list up here, plus a bunch more. It's almost this idea of any way you touch and use money, whether it's saving it, consuming it, and using it, all those verticals still have yet to have all the roads built on it. We barely even digitize the use of it now. And if you think about this opportunity, the reason it's so big today is because there's a new generation that's going to usher in the way it's going to be used. And everyone talks about millennials, it becomes a buzzword, but I think very few of us actually take a step back and say, wait a minute, we talked about baby boomers for so long, and there have been huge, massive financial services companies built really for baby boomers. Right now we have a generation that's coming into play, that's about to consume financial services en masse, and they're actually bigger than both generations in the past. And so when you look at it, there's 90 million millennials. They're actually increasingly disengaged from the in-person method of distribution. And on top of that, they have yet to fully consume financial services, financial products, how they save and use money, but they're about to. And so the question really becomes, who's going to pave the roads for this generation of consumers? Because whoever does will really usher in kind of that new era and really start ushering the era of digital money. And so, pop quiz for everyone here. I've listed a bunch of companies, maybe you guys have heard of most of them or a few of them. What do these companies have in common?
They were all responsible for the
All right, two answers. One was money. Second answer is they were all responsible for a digital crisis, or the financial crisis. Both are correct, but here's like a third one that connects them all together. When you look at it, whether you've heard of these companies or not, you actually have, right? Way back in the day, these companies are the ones that merged together and now have created Bank of America that we all know today. So both answers are still correct. Bank of America, you can argue, does both. But if you look at from 1990 until now, almost every financial services company that you have really heard of in 1990 has now consolidated into a handful of financial services companies. And these companies all used to be what we call like in-person monoline companies, right? The companies were really good at focusing on one product, one vertical, one client base, whatever it may be. And then we went through this era where everything was consolidated. And so if you look at this history, you say, all right, that's great. So these banks essentially built the first version of these roads. And game over. Right now we all have roads. But the problem is the roads weren't really created for a digital age. And also the other problem for them is that it wasn't game over. Because now if you look at it, you look at these banks and these banks have come under massive attack. This is just a handful of the companies doing it, but if you look at the bank at every vertical now, there are companies that are trying to disrupt that specific vertical, that are trying to do it digitally. And the reason I know is because one of the many ones is the company that I run. And so now if you think about the future, right, we're talking about the state of digital money, not what just happened in the past. Where does it all go? So you have all these in-person monolines. They did this massive consolidation in the last 15, 20 years. Now there's a handful of companies that essentially control all the relationships and really the roads to distribution. And then in the last 5 to 10 years, you've had hundreds upon hundreds of companies come and try to do this. And so with every single vertical, we can all probably name a bunch of companies doing it. But where does it all go? It doesn't just stop here. And that really becomes a question of who paves the next set of roads, who really creates that distribution model, which companies will really create the distribution for this digital money. And so when you think about who will win, that's always been a question every time I bring this topic up. People always ask who's going to win. One answer is we don't know yet, but there will be similar factors about the companies that win. First off, the companies won't be the ones creating just the product. Similar to how it's happened once already, where there's that in-person monoline consolidating into in-person relationships. It'll happen the second time. Right now there's a lot of digital monolines. And the question will really become, which companies will create the digital relationships, whether it's a consolidation or essentially a new company coming in and owning it all. But one thing we do know is it won't be focused on just one product, the same way that consolidation in the past was not focused on just one product. It also won't be a supermarket. I think we've seen a lot of this already happen in the last 5 to 10 years. And the supermarket is almost an inefficient way to consume these products. If you look at Bank of America, Wells Fargo, Chase, they are not necessarily a supermarket of these products. They right now have the financial relationships. And if you look at, say, my parents' generation, they do everything through Wells Fargo. When they go in, if you look at the rest of their wallet, it's been filled by that same company. It wasn't that they went to Wells Fargo and now they're choosing all these different products. It was almost as if Wells Fargo being that relationship essentially distributed every single product that they would need. Which leads me to my third point. It will be all about the relationship, which is part of the reason why it won't be just a product. It's not just product-based, just service-based. And the last one, because it's digital, the winner in a way will be the ones that are able to know the most about their clients, the ones that are really data-first companies. And if you look at the factors that will come into play, I think these three are really three of the biggest ones, right? First, it's about scale. Whichever companies will be able to disrupt the distribution has to do it in a massive scalable way, which is part of why digital will be kind of the factor pushing these relationships forward. It'll be about timing. That kind of relates to the last piece about data. It'll be this idea of which companies have the relationships and know exactly who the right clients are, exactly the right time they need what product, and how to give that to them. And the last piece is this idea about wallet share, right? It's really the companies that will be able to be that primary financial relationship, will be the companies that control the wallet share, will be the companies that build the road for distribution, will be the companies where, when you think about digital money and everything that everyone here is talking about, those will be products that use this relationship and use these roads that are built. And the reason you look at this and say, why is it the relationship? This is kind of how it's evolved over time. The in-person onlines had very little of all three, which was a real big factor to why in-person consolidated into in-person relationships. And if you look at 10, 15 years ago and you just saw that in-person relationship line, it would be all green, right? They were good at scale, they had wallet share, they were good timing. They knew when people needed products because you would walk into that retail branch every week or every 2 weeks cash your check, talk to someone, they knew when you needed the products. But now that's changed, right? Now this next generation barely does that activity. The only way I interact with my bank is through the ATM. So if you now look at what's happened, they still have scale, but wallet share and timing is really going out the window. And so that's where digital monopolies came in. They saw that opportunity. Their problem was they couldn't hit scale because single products don't give you that scale you need. So really this reiteration will happen again where these digital monolines, whoever becomes that digital relationship will be able to have the next version of this. And so this is one thing I always tell my company and tell my team and also tell our investors, right? This is just a race at the end of the day. It's a race between financial services, traditional firms and incumbents, and between the startups and fintechs. But the two sides have different strengths and different weaknesses. So whoever wins, it's about financial services. Who gets to actually innovate first? Right now, there isn't a lot of that happening, and it's not really built for that innovation, so that's kind of the weakness that they have to overcome. But when you look at fintechs, they're not going to win all either, right? Fintechs, they have to get to scale, and they have to build fast enough. And that's what is missing so far with a lot of the digital monolines. We have a lot of companies that have beautiful products, but they've been at it for years, and they put hundreds of millions of dollars into it, and they have yet to reach that critical mass. So if you look forward, in the next 5 years, some companies are actually going to start winning. Which one is it? Which leads me to my last thing, right? When you think about who wins at this, there's 3 versions I can think of. And a lot of it involves teamwork. But you can either have old school goes digital. So whether it's a bank or an incumbent, they're going to build, they're going to buy or partner. Most likely build or buy, right? Can they consume innovation fast enough and make it such that that's their MO? Or you can have new school, right? The startups. A lot of the startups are going to fail. If you look at it, most startups don't last, it was like 99% don't last 10 years, 97% don't last 3 years, right? So most of them who try to do this, it will not work. But there will be a handful that actually will be able to do it. They can do it by uniting. And the last one is go alone. And I think this is why fintech, financial services, digital money is getting a lot of attention over the last few years. It's not just a buzzword. It's this idea that whoever can win this game, if it is new school go alone or the banks reinventing themselves, it's not about this idea of who can become the next unicorn. When you look at the banks I showed at the beginning of the slides, most of them are companies that are $200, $300 billion companies. And so part of the reason why there's so much buzz in this industry right now is because fintech is not about creating the next unicorn. Fintech, in a way, is about creating that next $100 billion company. And so the next $100 billion company can do any of these 3, but which one will it be? So that's a little bit about what I'm thinking about. It's really about this idea of who will create these roads to distribute the products so that all the people who are creating these beautiful cars and destinations will have the road to drive on. And whoever is able to do that will have a huge opportunity at their hands. So disruption of the distribution of financial products and services. I want to open up to Q&A to anyone here.
What is your company do?
Sure. So taking a step back, my name is Vicky. I'm the co-founder of Wisebanyan. We are actually the world's first free financial advisor. So a lot of people call us robo-advisors, but what we do is we help people save money, invest money, do financial planning, and also find all the products and services they need. So if you were to look us up, you can actually start today. There's no minimum, it's all free. But it's this idea that we're one of the companies that are trying to create this road, this new paved road, rather than the bank's version of it. Everything we do is digital. And so as you're saving, as you're investing, as you're going towards goals and financial planning, that's one of the ways that you can create a road towards all the other financial products you need.
Has happened in the digital money, we do it in the digital money, or?
No, so it's not with digital money right now. And a lot of people, when I was walking around here earlier, asked me that question, right? Do you guys use digital money on your platform right now? Do you guys use cryptocurrencies? The answer is no, because if you think about it, right now there are very few ways to actually use that money, right? It's because the roads are barely there. So the first thing we're doing is, let's create the roads so the way we currently use non-digital money can actually be digitized. So if you think about what we do, the saving and investing part is digital. We recently launched an insurance product, for example, so when people on Wisebanyan are buying insurance, it's all digital as opposed to someone trying to sell them door to door. They can see their policy digitally, they can track their policy digitally. So it's this idea of, let's create the digital road first. Once you pave that first digital road, as people are creating these better cars and destinations, it's really easy to upgrade your road so that your road can now use digital currency, for example. So that's our thesis of, we'll start here as everyone else is starting here, and hopefully connects. Any other questions?
We can have 2 questions. So if you guys don't charge any as your financial advisor or advisor, are you thinking about at some point going into investing in the cryptocurrency space?
Sure. So there are two questions. One is how does my company make money, right? It's free. That's usually your first question. So it's a freemium model. We think saving, investing for goals, for long-term projects, retirement, kids, family, that should actually always be free, right? It's super commoditized now. I own a regulated company. It doesn't cost me $10 to do a trade for our own company, so it shouldn't cost you $10. So it's that idea of, because I've created all that institutional infrastructure, passing that savings to the consumer in the form of free. The way we make money is we provide services or products where the products themselves are not free. So you can either choose, we have investing products that are for people who have very different needs or trying to optimize different parts of their lives. And so we have subscription products that you can opt into, or if you come to us and you're saving for that home, and now you're ready to buy that to get that mortgage, if we connect you with someone, that would be another way we make money currently. And the second question is, because we help people save and invest, what about saving into digital currencies or investing in cryptocurrencies? So your short answer right now is we don't have it yet. But the bigger question becomes, when will the mass consumer be ready for it? It's not so much a challenge for us on the technology side or kind of knowledge side, but when you think about it, right now we're all here talking about cryptocurrencies. But if I drive 10 miles away and just walk down the street and start asking people, what do you think about cryptocurrencies? Which cryptocurrencies do you own? I think I would get a lot of funny looks, right? So it's that idea where I think the mass market isn't quite there yet, and that's what a lot of people here are working on. So what we're constantly monitoring is when does the consumer really want to start saving and investing into that piece of it? And if it's right now, I'll hear them out and then build it for them. I think right now what we're trying to solve for is a lot of people aren't saving and investing to begin with, right? There's already enough challenges even without taking a digital part. So I think it's somewhere that we're thinking about, or I don't think the market's quite there yet.
Fiduciary rule, how is it impacting?
Say that again.
The fiduciary rule, how has it impacted your company?
Sure, so the question was the fiduciary rule. How has it impacted our company? I've always been a huge fan of the fiduciary rule. I think right now that when you look at what's happening, there isn't too much clarity yet, right? The timeline's moved in terms of what's actually going to happen. But if you look at our company, we are a registered investment advisor. We are also a registered broker-dealer. So we've always had a fiduciary responsibility to our clients. And I've always been a huge fan of making sure every consumer actually has a company working for them that actually is a fiduciary for them. So in a way, the faster that happens for everyone, the better it is for consumers. And because we're advocates for the consumers, we've always been advocating for that. Sure.
Do you use blockchain technology?
Myself personally, or?
Your company.
So the company does not. And going back to the same reasons, the technology itself, I think it's actually more interesting right now than the cryptocurrency itself. But in terms of what we're trying to do, the lower hanging fruit is actually helping people be able to more easily find products and in a more transparent way. So I think even if you think about a lot of the products I showed earlier, insurance, student loans, lending, mortgages, a lot of those products aren't even there yet to the point of needing blockchain technology or using a ledger. A lot of the challenges that they're facing is actually how do you make it more transparent, how do you make it easier to use, how do you make the client experience better. So that's what we're actually tackling first.
So you're a FINRA dealer, correct? You're a FINRA dealer?
Yeah, so we're regulated by the SEC and FINRA.
So you're a FINRA dealer, so your company is?
So our company has a FINRA member broker-dealer and also SEC registered investment advisor. So we're regulated by both.
So you've been around for a while,
right? We started the company actually 3.5 years ago. And so we've been around for about 4.5 years now.
So what is your vision about the very critical conference of digital currency and digital money? What is your vision? Is this going to be something in the future that everybody will invest in millennials, another student loan, insurance? This is your vision?
Sure. So my vision is, first, I do want everyone to be able to use digital money. I think it really starts with when you think about how people use money now, can we make sure that when we use money now, it's digital? And the consumption of it is digital. And then can we think about how we digitize the money itself? So when you think about how people use money now, our vision is, if you think about, going back to the analogy with the roads and the cars, right? Who built the first version of these roads? It's a lot of the companies I showed at the beginning that consolidated. And the roads that they built are almost these dirt roads now, right? It was great for the old Ford T model cars or bikes, but it's not great for the cars we have today. And so it's this idea of who will pay the second version of the roads. It could be these incumbents, it could be the newcomers, it could be a combination of both. So it's this idea of the vision is let's first build the roads. It's almost this idea of building a bank from the inside out. And then once that is there, people can consume all the products we're consuming now digitally. Let's think about how can we turn the money piece of it also digitally. And it's almost this upgrade to this road infrastructure.
So you have a platform, right?
Absolutely, yep.
So I mean, does your company see yourself as marketing as much SoFi? I mean, SoFi is marketed to the student loan and that loan out. Is this something that you might be doing and marketed to a younger audience?
Yeah, so right now, so we launched 3.5 or 4 years ago. Right now we have about 40,000 people who are using Wisebanyan. And they're using it to save, to invest, to financial plan, to buy other products as well. And so the majority of how people really think about using money first is, what do you need money for, right? People don't care necessarily about dollars and cents of money. You want money for what money can get you. And so when people think about money, it's often, I want to be able to have an emergency fund. I want to buy a home one day. I want to make sure my kids are able to go to school, or I want to buy whatever it may be. And so what we do is really focus on that. Saving, investing is just a means to it. Same thing with financial planning is a means to it. Same thing with consuming other products. And so that is kind of what we do. The key difference, though, between a company like Wisebanyan and a company like SoFi is SoFi is starting with a product that's geared towards people, millennials who have college degrees who are trying to refinance their student loan. Right? So it's almost this idea of starting from a transaction, a student loan transaction. But when you think about the broader market, I think the much broader part of it is actually how are people saving money, right? And what are they saving towards and how are they planning for it? And so that's the piece that we start with. So we certainly do have a lot of young people who use it, really popular with millennials, but you don't have to have gone to college to use Wisebanyan. You also don't have to be a millennial to use Wisebanyan. We also have a lot of people who've just never been able to start saving and investing. And now they have a way to do it with $1 for free. And so it's that idea of how do we help people build bigger roads for more people to try on.
Doesn't need to be a accredited investor, correct? Anybody can invest in your platform?
Exactly.
Thanks.
And then,
coming from I mean, you're a regulated company or a regulated business. How have you dealt with challenges such as within that model, such as suitability requirements, things like that? And as being a digital product, are you encountering additional complications with that, or?
Sure. So the question is really around how do we make sure whatever we do for our customers is one, under a fiduciary standard, and two, is right for them, right? And so when we think about it, it's this idea of, 10 years ago, if you walked into a branch, say Merrill Lynch Private Wealth Management or whoever's down the street, they would try to really personalize whatever product was for you. But they would do it by essentially asking you a bunch of questions, and then in their heads or in the spreadsheet trying to figure out what's unique about your situation or my situation and create a product for that, or giving me a product for that. But in a way, that's really hard to do scalably. And so the challenge with technology is once you start doing that, you open the doors, it's not just for one person, right? The next day you have 10,000 people coming in and trying to use your product. But the upside and opportunity of what we've done is to do that same thing where you're trying to really understand each customer and create a really personalized product for them. Technology is a perfect way to do it, right? Everything we do is actually super highly personalized. And so when we build everything we do, it's from this idea of how do you recommend the right product, the right action to the right person, and it's taking in all the inputs of that person and calculating something that, as a human, it would take me a long time to do for just one person, let alone 40,000 people. And so if you look at our product, everything we do is personalized, all the way from what type of goals you're trying to save for. You might be trying to save for 4 goals with very different time horizons. I might be trying to put just a few dollars away. Someone else might be trying to get ready to buy a home. And so everything we do is run through our same product. Our recommendation engines and our products themselves and how we help people is all highly tailored. So in terms of the algorithms we built, in terms of our product, it takes in hundreds or thousands of factors and then is able to provide a personalized service to each person. And you get a question as well.
So there has been some robo-advisor in the space, like Betterment and Wealth. What is your competitive advantage in this evolving on and building?
Sure, so the question was, What we're calling is robo-advisory. So it's this idea of a robot advising you on your money. But there have been a few other players in the space. So you mentioned Bearman, Wealthfront, Wisebanyan, Charles Schwab has launched a robo-advisor. So it's incumbents and startups as well. But what is the difference between our company and theirs? So one really big difference is we're actually able to help people who have never started before. So a good example is we have no minimum, right? So even Bearman and Wealthfront, companies have a small minimum, and if you're sitting there and you're saying, well, $500 or $1,000, what's the big difference? The big difference could be 78% of the US market, right? There was an article published in the Atlantic a while ago that said 1 in 2 American households would not be able to find $400 for an emergency today without selling something. So if you think about that, the idea of a $500 minimum already automatically sections up a huge portion of the market. And so that's one big piece of it. We're free, that's another big piece of it. But the really big piece of the difference is that we're actually not just about savings and investing, right? We are actually about how do you reach your financial goals faster. Reaching your financial goals could mean you're just trying to save a few $100s. For someone else, it could mean, I want to make sure I can refinance my student loans. For someone else, it could mean, I just had a family, so I want to make sure I have money saved for them, I can buy a house for them, and also what else do I need to understand? Is it insurance? What do I need? And so it's this idea of what we're doing is really broad, and saving and investing is just one piece of it. So in a way, we compete with them with one segment of our product, but we're doing a lot more than just robo-investing piece of it. Are we short on time?